Hello everyone, this is Adil and I welcome you to today's live webinar on 4th of March. And today we will be talking about a very interesting topic which has been catching a lot of attention by the local Aussies, and that is rent vesting. So what rent vesting is, who does it apply to, who can do rent vesting, what are the pros and cons, things like that. So we'll go through and run a scenario very quickly just to give you some perspective about the thing and crunch some numbers so that you can figure it out whether it makes sense to you or not. So if you want to book in a call with myself, have a chat, try to understand your personal situation, feel free to book in a call. The QR code is right in front of you. And if you're joining us now live, please let us know, leave us a comment, let us know that you are here. These sessions are for you, so we look forward to your feedback, your questions, anything you want to talk about around property or around rent vesting, which is our topic for today. And if you're watching the recording, please let us know that you've been watching it. What did you find? If you found any value out of it, if you have any questions, if you have any suggestions, please let us know. So we will be talking about rent vesting today. And before I go into the details, let's go through the disclaimer, the financial disclaimer, and that we have. So any information presented in today's webinar is purely generic in nature and does not take into account your specific personal and financial situation. We are not providing any kind of financial tax or legal advice. Please make sure to seek your independent professional advice before you decide to act on any information which is presented today or which gets discussed in today's webinar, because the information presented is only generic in nature and may or may not apply to your personal situation. So with that disclaimer, I would like to dive into our topic for today, which is rent vesting. Now, before I go into rent vesting, just wanted to share a quick news with you guys as well. So as we know, that interest rates finally got a drop a couple of weeks ago, and we all know about it. We all had a big sigh of relief. There may potentially be more cuts coming along the way, but as I've been saying before as well, don't expect a flurry of rate cuts. They potentially will happen, but very slowly. And I believe that's the right way of doing them as well. But another good thing is that the home values in the month of February actually immediately responded to this rate cut. And this is, which I'm sharing from, which was reported by news.com as well, that in February, the house values increased by 0.4%, which seems to be a very small number. But the more important thing over here is that leading this gain has been Melbourne. So Melbourne in the month of February actually went up by 0.67%, followed by Sydney, which went up by 0.5%. That is a good sign. That is a very good recovery sign for Melbourne. But again, it's too early to say whether Melbourne is one of the best places to be buying in right now. From investment perspective, yes, we are buying in Melbourne. We have started buying in Melbourne for the last 6 to 8 months in different pockets. Not everywhere in Melbourne is worth buying. So you have to be very selective about the pockets. You have to stay away from oversupply areas. That is a case in a lot of areas in Melbourne. So yes, Melbourne is a good place, but as long as you know what to buy and where to buy. So nationally, the home values have risen by around 4% as compared to 12 months ago. So that is a good solid increase as well. And that has been at the time when the interest rates have been really the highest in the last 12 years. So that is what I wanted to share with you. Moving forward, I'm just catching my breath now. So if you have to decide now what rent vesting is, rent vesting essentially means, yes, we have an Australian dream. We want to buy an Australian home, right? So that is the dream we get sold to, that you have to buy and you have to work for an Australian home. That's true. But on the other side, rent vesting is also a concept and it applies to a lot of people. I'm doing it personally for myself and I'm a big advocate of that. And I will show you the numbers why I believe rent vesting works for a lot of Aussies, especially the Aussies who are looking to enter into the property market, who are looking to buy their first property, and they are based in Sydney or in Melbourne. Those are the people who can really benefit from rent vesting, and I will tell you why. Why specifically for Sydney and Melbourne people? Also, a lot of people are struggling with deposit. So anyone who's struggling with a low deposit, anywhere between $50,000 to $80,000, I think buying their first home may still be the best option for them, because essentially they can get potentially first home buyer grant, first home super saver scheme, and all those schemes which are out there. Again, you have to speak to a mortgage broker to to understand which scheme you are eligible for. If you want to be connected to a mortgage broker, please feel free to reach out. I'm more than happy to make an introduction with one of our trusted broker partners. But having said that, if you're low on deposit around 50, 60, 70K, and you're looking to buy your first property, I think rent vesting may not really work for you. That is where buying your first home as an owner occupier home will be the way to go for you. But having said that, that first home that you will be buying, remember, you will be buying based on your budget. You will be selecting the location, you'll be selecting the area based on your budget because you're tight on deposit. So you can't do much about it. Well, now, whether in that area and whether the property that you can afford in your budget, whether that will grow in value or not, you will have to rely on whatever is happening in the local market. You can't really change much because, again, budget is a constraint for you. But still, it's better to get into the market instead of just sitting on the sidelines. So make sure you get into the market the sooner you can. I mean, that's what my advice is. If you don't want to get into the market, that's fine. But that's what I would recommend anyone. But having said that, essentially, with that kind of deposit of $50,000, $60,000, $70,000, yes, you can get into the market with 5% deposit, but essentially you will end up buying a townhouse in Sydney. You can buy a house in Melbourne. Yes, you can buy a house in Brisbane as well, in Adelaide as well. But in Sydney, essentially, you will be tied up buying a townhouse with that kind of deposit because you will only be able to afford, like, say, 800, 900K property, which gives you a good townhouse, but not a good house. So the growth of that is a question mark. It will take time for that to grow. But again, if you don't have any other option, then that's probably your only option at this time. So rent vesting is out of the picture. But what if you have $80,000 savings or more than that? If you have more cash sitting with you, then what you should be doing? Then that is where I want to discuss about what rent vesting is. Now, rent vesting, which I personally do myself, is all about renting where you love to live at a fraction of a cost of what the mortgage payments would look like if you were to buy in that suburb. As an example, I live in a suburb where the median house price is around 1.8 mil. The mortgage repayment would be around $10,000 a month. I don't want to pay 10,000, so I'm renting the same property for like $3,500 rental expense. So I'm saving a lot on my money and I'm using that money elsewhere, which I will show you exactly where I'm using that money if you continue watching. So the idea is that once you do rent vesting, essentially you are renting in areas where you want to live, but you're buying strategically in other locations across the country where it makes financial sense, where the numbers actually work for you. And that's where the board actually opens up for you. You're not just looking in Sydney or Melbourne or Brisbane where you live, but essentially you are looking across the country and the whole door of opportunities open for you, because guess what? The idea is that we want to use this Australian property landscape to create real wealth safely. And that's what rent vesting has been doing for a lot of Aussies right now. And that's what I want to share with you as well. How do you do that? Let me run through a scenario. Now, let's say, as an example, I'm going with Sydney property here. Sydney median price is around 1.4, 1.5 million. Again, it can vary with different suburbs. It can be cheaper in some suburbs. A lot of suburbs are much more expensive, 3, 4, 5, 6, 7 million as well. But I'm talking about the city's median. So for our today's example, today's scenario, we are talking about if you have to buy a house in Sydney, which is around 1.4, 1.5 million as a median value, and that is your first home. And let's say for the sake of this example, you have $200,000 sitting in the bank account. Now, I know a lot of you don't have that amount of cash. That's okay. The example still applies to you. And I know a lot of people who have much more cash than 200K sitting, because we talk to a lot of people every day. So if you have more than 200K sitting in your bank account, it will still work for you in most situations, right? Now, I'm putting it as my own case study, as my own scenario over here. Let's say if I have $200,000 today, and if I'm to start property investing, what will I be doing with all the knowledge that I've gained over the last 8-10 years in property market? If I have to buy a family home, the Aussie dream, if I go down that path, then essentially I'll be looking to buy a 1.4 million family home in Australia, for which on a 10% deposit, I need $150,000 cash plus some more, a little bit more for stamp duty and things like that. So my $200,000 will be pretty much spent on that. And my loan amount will still be 1.35 million, which means on that $1.35 million loan, which I'll be paying on a $1.5 million property, I'll be paying roughly $8,269 in mortgage repayments. Now, this calculation is based on 6.2% of interest rate, which is prevalent today. Now, the most important thing I want to emphasize over here is that repayment of 8,200 or 8,300 dollars every single month. If you break it down, essentially you are only paying around $1,200, $1,300 of interest on that. But you are paying a massive 6,900 or close to 7 grand interest on that repayment every single month. And the biggest disadvantage, in my view, of owning your own home is that interest expense is not tax deductible. There's no way you can actually claim a compensation or a tax deduction on that. You just can't, because you're living in an owner-occupier home. And that is where rent vesting actually helps you claim deductions on that expense every single month. And that is what I'm going to show you now. So one option was I buy my family home worth 1.5 mil. My loan is around 1.35. My repayments are around 8,300 every single month, out of which I'm not getting any tax benefit. But what if I rent the same house? What if I decide I don't want to pay 8,300 every month for mortgage? I will just rent the house. And the same house can essentially be rented for $800 a week, because the rental yields in Sydney and Melbourne are very, very low. And what that means is that Sydney and Melbourne usually is not a good place to invest for a lot of people, because that stops them from borrowing more money. They can't just borrow more because their rental income is so low. They're hugely negatively geared. So their income from the rental property is lower and their expenses are much higher. So that's where Sydney and Melbourne doesn't work for a lot of people. So essentially, I want to use that for my advantage. So instead of buying any investment in Sydney, what I would do is I would actually rent a property in Sydney, because doing that, I can just do it for a fraction of a cost. And renting a property which is worth 1.5 mil, but I can rent the same property for like 3.5 grand expense every single month, because 3.5 grand roughly is the rent that I have to pay for that property. So if I bought that property, I was paying 8,300, 8,500. But if I'm renting that property, I'm only paying 3.5 grand. So essentially, I'm enjoying the same lifestyle. I can live wherever I want. I can choose whatever schools my kids want to go to. I can choose whatever area. All I need to do is find the right rental property. And then I can actually save anywhere between $4,500 to $5,000 every single month, because I'm not paying any mortgage on that one. So that's the basic first number I wanted to share with you. That's where the advantage starts kicking in. I need to be quick because the time is running fast. So let's go what I will be doing now. If I'm renting that same house, now suddenly I still have $200,000 remaining because I haven't bought any home, but I'm renting a home, and I have $5,000 savings every month. So I have 5 grand of savings and I have $200,000 cash. What do? I'll go start rent vesting. How do I do that? I will split that money into two parts. Instead of buying one property and using all of my cash of 200 into one, I will split into 100 plus 100. I would rather target two different properties. Now, because I'm buying investment properties, yes, I will have to pay stamp duty. Now, that's another thing that puts people off from doing rent vesting. They say, oh, why should I pay stamp duty? But I'll show you how the numbers work. Yes, you will have to pay one-time stamp duty of around $18,000, $20,000 for each property, maybe up to $23,000, $24,000 as well. Depends on the state and depends on your budget. But essentially, if you look at the numbers over here, I'm using 100K to buy one property, which is around 600K. I'm using another 100K to buy another property, which is around 700K. I'm paying stamp duty on that. I'm paying all this, that upfront cost. I'm not getting any first home buyer grant. Yes, because I'm buying investment properties. I'm not getting that small 10 grand because that actually pushes me back financially, and you will just realize how. But I'm buying properties which are coming with two very good traits. The first trait is they have decent rental income. So even for a 600K property, I'm expecting 500 to 600 a week in rental income. For a 700K property, I'm buying in areas where I can get 600 to 700 per week in rental. Because suddenly if the rental income goes up, that will not only help me in servicing my loan easily, but because I'm servicing it well, I will be able to get further loans, future loans for future properties much more easily. Also, the other important thing, not just rental income, the other important thing I need to look at it is growth. If you're into property investing and you're not looking at growth, you are in it for the wrong reason. You're not in it for the rental income. You should be looking for growth. That's the main driver. That should be your main motivator. So we are buying in areas where you should be targeting at least 6 to 10% of annual growth on average. Now, 6 to 10% annual growth should happen in the first 3, 4, 5 years. It will not happen every year. Some years you may get only 5%, 4%. But in the first 3 to 4 years, 5 years, you should be targeting areas where you can get 6 to 10% growth, which is above average growth in Australia. How do you find those areas? I've done several videos on that, how to find high growth areas. So you can go back to my channel. You can look at the videos of how to find high growth suburbs, and you can look at them and identify those growth suburbs. But that's the key. Once you are in those high growth areas, once you are buying properties which are giving you high rental income, that is when you will still have a bit of a mortgage gap. You will still have a bit of council rates to pay from your pocket. And that is where your monthly out of pocket expense, the last item on this line, will be around $1,000 for each property. So yes, you will be forking out $1,000 every month on each property, which comes down to $2,000 a month. Now remember, you were actually saving $5,000 before. So I'm just going back. You were saving $5,000 a month just by renting a house and not buying a house with a big mortgage. So from that 5,000, you can easily chuck away $2,000, even $2,500 on these two properties just to hold on to them. Just stay with me for a couple of minutes and you will know the advantage why I'm asking you to do that. The tax benefits. Now, what are the tax benefits of these two investments? Remember, if you bought your own home, there were no tax benefits essentially. In this case, you're getting tax benefits. The first thing is all your interest repayments that you're doing, they're all tax deductible. All the council rates, insurance cost, maintenance cost that you are enduring, all the property management fees that you're facing, all the improvements you're doing, they are tax deductible because it's an investment. So essentially, your annual taxable amount actually reduces. So you're reducing it by you're spending $1,000 on each property out of pocket every month. Across 1 year, you're spending $12,000 on property one, $12,000 on property number two. So essentially, if you are on a 37% of tax bracket, so you are getting around $4,500 back from ATO at the end of the financial year. So when you do your tax returns, you will tell your accountant that on this property, I'm out of pocket by $12,000. On the second property, I was out of pocket by $12,000. So on these two properties in combined, yes, I was out of pocket by $24,000. But out of that $24,000, you will be getting around $9,000 back, roughly. Again, you have to check the exact numbers with your accountant. It can be slightly variable, but that's the biggest advantage. Your cash flow gets supported from there. That is one thing. Now, if we just continue by 2028, let's say 3 years from now, you should be in a position, because you bought properties in good high growth areas, 3 years down the line, because your properties are generating good rental income, if you go back to the bank and tell them that my properties have grown in value and they've also been getting good rental income of $600, $700 a week, what do we do with that? They said, okay, you have enough equity and you can recycle that equity. You can take that money out and you can service further loans. Now, I suggest to you over here, go and talk to your mortgage brokers and ask them the importance of rental income on your investment asset. The more the rental income, the better it is. That helps you to keep servicing it, taking the equity out to buy more properties, using that money as a deposit. And that's our major aim, because now we are in leveraging state. We want to leverage the market. From these two assets, by 2028, we want to make 4 assets. And that is very safely possible to do. And that is what our clients are doing as well. And that is what you can do as well. So from these 2 assets, we buy them today. In 3 years' time, they will give us enough growth because we bought them in good high growth areas with good rental income. So these doing rent vesting, these assets will allow us to generate another $100K deposit for each property roughly. And we can buy 2 more assets by 2028, which takes our total portfolio to 4 properties. Now, having 4 properties essentially means if I bought 4 properties, and let's say if I bought a family home back in 2035, that home which was bought like a family home for 1.5 million, that would still be around 2.5 million. And I'm assuming $100,000 of growth every year, which is good, which is a very solid growth. And yes, equity has been made. There's 1 million equity made over there, but I can't use that equity because I cannot service that loan unless my income has gone up. So having your own home in Sydney specifically doesn't help you to borrow more money, because yes, the values go up in Sydney, but they go up elsewhere as well. But the problem with Sydney is because your income have to rise with that as well, exponentially, so that you can actually cash out that equity and use that as a deposit, which a lot of people cannot do. So that's where even after 10 years, let's say in 2035, you have bought this property for 10 years, it has done amazingly well, the equity has gone up by 1 million. You still can't refinance that unless your income has gone up by 50% or 100% by that time. You still can't refinance and buy further properties. which means your leverage power is limited. And that is where rent vesting helps you solve that leverage problem, because you're buying assets which have high rental income and high growth at the same time. So moving forward, if you rent vested today in 2025, then by 2035 you should easily have 5 to 8 property assets, which should be anywhere between $3 to $5 million. Your portfolio at that point, from 2035, it should be growing anywhere from $300 to $400,000 every single year just by holding on to them. And I'm assuming a very average 7% of growth rate over here. It's all about finding those right assets, taking 5 or 6 years to buy them, and then holding on to them for another 5-10 years. That is how the leverage starts kicking in. So while I was doing rent vesting, I was able to accumulate not just 5-6 assets. Those assets are also helping me create wealth of anywhere from $250,000 to $400,000 every single year, because they are rising in value. The loans are going down now. But what the most important thing is, I did not have to sacrifice my lifestyle. I did not have to work 3 different jobs to actually buy or build a property portfolio of $3 to $5 million. I actually use the market dynamics to work in my favor and grow the portfolio. So essentially, I'm still having a good lifestyle. I'm still enjoying with the family. I'm still going out. I'm having holidays. I'm going out, eating out in restaurants. I'm not saving money like a complete maniac where I just want to save a deposit for the family home. Yes, it's good to save a deposit for family homes, but to just save a deposit for a home which you will just pay off for the next 30 years out of your own hard-earned money is extremely unsensible thing to do for me. Again, I'm talking from the numbers perspective. I'm not talking about emotions over here. But if I rent vested and I rent vested for 20 years, let's say, so by 2045, my property portfolio should easily be sitting at $5 to $8 million. I don't need to do any more purchases after first 10 years. So whatever I purchase in the first 10 years, I'm just holding on to them now. And now the loans have gone down as well. The rental incomes have been rising by 3-4% every year. So let's imagine by 20 years, the rental incomes have gone up by 50, 60, 70% at least. And because of that, now I'm in a position where in 20 years from now, I have a 5, 6, 7, 8 million property portfolio, which still has debt on it. Remember, now don't say that debt is something bad. If you don't date debt, you won't be in that position, which I'm showing you right now. So you need to be able to manage the debt correctly. Don't run away from it. Use it wisely. That's what I would suggest. But now I have 2 options. After having owned these properties for last 20 years, now I have 2 options. First option is I sell half of those properties. I take the cash, I pay the capital gains tax. Yes, there will be capital gains tax, and you can minimize it if you do the right trust structure when you're buying the property. So buying the right trust structure can help you do a bit of tax planning and saving on tax potentially. But that's where you need to be talking to your accountant and seeking further advice. If you want to speak to an accountant, let me know. More than happy to connect you with a trusted accountant who can help you save tens of thousands of money over the longer period of time. But having said that, I have 2 options now. One option is I pay half of the properties. Out of my 8 properties, I can sell 4 of them, pay all the selling agent fee, pay all the capital gains tax, and use that leftover money, which will be anywhere between $1 to $2 million, and use it to buy my desirable home as cash. So I can buy a $2 million home or $2.5 million home pretty much with full cash in 20 years. Now, you may argue that that home will be $3 million by that time. That's understandable. It may be $3 million, it may be $3.5 million. But if I can buy a $3.5 million home with $2.5 million of cash and just have $1 million loan on that, who won't take that? Well, I would definitely take that every day, right? So that is one option, that I can buy my family home pretty much full of cash without any mortgage repayments on that. Or second thing I can do is that I can sell half of the portfolio, take the proceeds out, pay the capital gains tax, whatever money is left, I use that money to pay down the debt on the existing properties, the ones that I haven't sold yet. Pay down their debt, bring the debt to zero, make those 3 or 4 properties, which I'm still keeping with me, as debt free. And those properties are enough to give me anywhere from $150,000 up to $300,000 of passive income on which I can live and which I can survive very, very easily without having to rely on government pension ever again. This is powerful, guys. I'm talking about rent vesting, where using rent vesting, you can create practical financial opportunities for yourself. you can use it for other stuff as well. You can either buy your family home, you can pay off your investment loan and live off the rental income, or you can use that money to pay off. Uh, Thanks for your comments, guys. I'm seeing a couple of comments. Thank you so much. Thanks for Yasin. Thanks for Margaret for tuning in. You can also use that proceeds for other stuff, like you can pass on that to your children. Who won't want to pass $1 million to their kids in 20 years from now, so that they can use that as a deposit? And all their parents did was just to buy the right assets 20 years earlier to make that happen. And those assets which were actually paying off for themselves and also growing in value every single year. So that is very simple. That is a mathematical way of looking at it. And I feel that is something that everyone should be considering. Even if you have your own home and you still want to invest, try to invest in areas where you get good rental income and good growth at the same time. If you're looking to buy your first home, rent investing is definitely something I would recommend you to have a look into. Now, enough of rent investing today, guys. I hope you got any value out of it. If you have some questions, please let me know. Give me a feedback. More than happy to have a chat. And deal offer this week. So we bought this property for a client in regional Victoria for $522,000. Again, it's a town with like 90,000 thousand people. Sorry, not dollar. 90,000 residents over there. It's a big town. It has a very diverse economy. So it's not like a mining town. It's not like a small town in the middle of nowhere. It has its own agriculture. It has its own manufacturing. It has its own very good transport connectivity with major cities. And it's a very good area in terms of its own hospitals and health infrastructure, and also other infrastructure coming through the state government planning. So this is the area we are talking about. Already renting for $530 a week, which is very decent rental income. And because it's a house and because it's in a high growth area, we are expecting that over the next 3 years, it should give growth of anywhere from $150,000 to $200,000 to our clients. And then they can just use that growth to recycle, buy more assets, or they can even build a granny flat at the back of it because it's a big block. So they can even just add a granny flat on it by taking some loan, and their cash flow would go from $530 to maybe $1,100-$1,200 by 2028. So yeah, that is the deal of the week, guys. And if you have any questions, if you want to reach out, if you want to discuss your property goals, your property aspirations, feel free to book in a call with myself. The QR code is right there. Scan the code, book in a call. And if you found value from this session, let us know. Give us feedback, please, and take some action. Knowledge is good, but the knowledge that gets used is the only one that is good. So whether you work with us or whether you work yourself, I'm perfectly okay with that. But please take some kind of action. Take care and stay safe. Thank you.